Affirmative action. When she was chairman of the Fed, I said she was incompetent, and I was right. And then she became Secretary of the Treasury. She's a statistics geek from Berkeley. She's got a big brain. I'll give her credit on IQ points. So what? That's not the same as common sense or working knowledge or knowing how the street works. She's never worked, outside of government in her entire life. I don't care what your resume is. If you've never run a business, met a payroll, negotiated a purchase sale agreement, kept your morale up with negative cash flow. If you've never done any of those things, you don't know what it's like to be in the real world of the economy. She doesn't. But her specialty as an economist was labor economics. Okay, well, there's a place for that, but not as U.S. Treasury Secretary. You have to know she didn't know monetary policy of the Fed. She doesn't know fiscal policy of the Treasury. Knows nothing about international economics, and that gets us into the role of the dollar. She was like her husband won a Nobel Prize. Okay, George Akerlof. I know a lot of her close associates. If you don't want to say affirmative action, you can say the Peter Principle, which, this goes back to the 60s. But the Peter Principle is you get in a bureaucracy and you do a good job and they give you a promotion. And then you keep doing a good job and they give you another promotion. And you keep doing a good job. And eventually you get promoted to something where you're incompetent. You're in over your head and you fail, but then you stay there. Because you're not getting another promotion. And so the result is bureaucracies are populated with incompetent people because they've all risen to their level of incompetence and have nowhere else to go. I would say she got there at the Fed, how she got another chance at Treasury, but that's the answer. But Lael Brainerd, I'll say, is more talented, and hopefully she'll be. So they'll throw Yellen under the bus, blame her. By the way, that's the Biden technique: deflection and denial and just blaming other people. So they'll blame her for the whole thing. She probably doesn't see that coming, by the way. Maybe she should tune into London Real. And then they'll put Lael Brainerd over there. But Mary Daly was on the short list to fill Brainerd's seat at the Fed. Well, you can forget that she can't get to a hearing at this point. But she was running around on, climate change, social justice, George Floyd, BLM. And again, free country, you want to express a view, be my guest, but not as chief regulator of Silicon Valley Bank.
Yeah. It's so should they have let it fail? And what would have been the carnage, Jim, if they had?
Well, again, it's hindsight. It shouldn't have been allowed to get to that place anyway, but there might have been more. This is where there's a lack of creativity. It's kind of all or nothing. It's like, if this fails, we're going to have a wave of failures of startups in Silicon Valley. That's probably true. But most of them fail anyway. If you know the venture capital business, and I'm sure you do, most of these things fail anyway. A couple of winners here and there. Well, how difficult would it have been? So now you're the entrepreneur. You had $5 million of working capital, which you got in a round, an angel round or whatever from some venture capitalists in Silicon Valley. You got some premises, you got a payroll, you got some developers, you got employees, all that stuff. And now your cash is frozen. Not just frozen, but gone. You got a Yang money, you got a due bill from the FDIC. Who's to say if those companies were well run and they actually had some good technology, how difficult would it have been to make a few phone calls and say, you know what, we're stuck in this thing. I need a 2-year bridge loan, or I need a 1-year bridge loan. And I'll collateralize it by the proceeds of my receivership certificate. And as and when I get paid, I'll pay down the loan. We can have a simultaneous closing, all good. You could have got money. Some of those firms could have got money. Some of them not. Maybe some layoffs. Maybe they would have failed, but most of them do anyway. I mean, that's my first point. But that was not the majority of, and unemployment would have gone up. I mean, I'm not saying that there are no hardships, Brian, but we gloss over the greater hardships on the economy as a whole. And that gets to the other lie, which was Janet Yellen coming out and saying, there's no cost to the taxpayer. Like, wait a second. Because you mentioned the bailout of the Fed taking the loans below market value and giving them, at market value and giving them par value, which is more for 1 year, and glossed over that whole thing. But there was a separate bailout, which is the FDIC guaranteed every penny of every deposit in all those banks. Well, when you look at the numbers, you have grossly depleted the insurance fund. The FDIC is an insurance company. That's what the I stands for. And they have reserves, just like every other insurance company. They charge premiums. That's how they go. This would have basically wiped out the reserves. So how are you going to top up the reserves in the FDIC for future bank failures? Well, they said, we're going to raise premiums on the banks. Okay, they are. But what do the banks do? Well, they're going to either pay you less interest or charge you fees. In other words, the bank isn't just going to sit there and write checks to the FDIC and watch their P&L evaporate. They're going to pass the cost on to the customer, which is us, which is the American people. So does your tax bill go up? No, but your interest rate's going down or your banking fees are going up. So the cost is shifted to everyday Americans. So don't tell me that we're not paying the bill, because we are. So again, these are in the nature of government lies to kind of, disguise what they're actually doing. Well, that's a great question. I do think that's the next battle space, as we put it, in European banks in particular, but internationally. But there's a thread that runs from Bitcoin in November 2021 through Silicon Valley Bank to Credit Suisse. Let me explain what that is. What's going on is contagion. It's financial contagion. And the word contagion is not just a kind of cute metaphor. It's the mathematics of a viral contagion, which we've all just lived through with COVID, and we don't need to rehash that, and a financial contagion are the same. Robert Schiller pointed this out in the book, but I had identified it years ago, and I use it in my own analysis. It's called the SEIR model. And S is for susceptible, so like you might get the disease. E is exposed, you were exposed to it. I is infected, and R is recovered. So are you susceptible? Did you actually get exposed? Did you get the disease? And did you recover? They left out dead. I mean, there's recovered is like what's net of people who get it, and some of them die. And there are the banks that get carried off the field. But the math is the same. And so when we look at how disease spreads, financial panic spreads the same way. Now, this panic, you can say it started with Silicon Valley Bank, and that's fair enough. But this goes back to November 2021. That's when the Bitcoin crash began. So between November 2021 and November 2022, Bitcoin fell 70%. It went from about $68,000 to about $15,000. Now, I know it's back. It's up over 25. That's Bitcoin. But that happened. And a lot of people had Bitcoin loans. They had deposits in crypto exchanges that themselves had overinvested in Bitcoin or had leveraged bets on Bitcoin. So you were seeing a crypto crisis. You were seeing a financial crisis in crypto land with Alameda, FTX, of course, that was a fraud, Genesis, Three Arrows. There were and they're still happening. There were a whole series of crypto firms collapsing. And I was watching this, and the question I kept asking myself is, okay, there's a fire in crypto land. They call it the crypto winter study. Does that jump from crypto land to mainstream banking? That was the question I was asking. It's in biology, it's called a zoonotic transfer. Does it go from the bat to the human? Although the Wuhan virus came from a lab, but the idea that there is zoonotic transfer is true. So I said, does this somehow jump from crypto land to mainstream banking? And it did. And the vehicle was not Silicon Valley Bank. It was something called Silvergate Bank. Now, Silvergate Bank announced it was filing for bankruptcy the day before Silicon Valley Bank went down. But what's special about Silvergate Bank? Silvergate Bank was a regular bank. Remember the Federal Reserve System, FDIC insured, but it was completely in crypto. It was financing crypto lenders. It owned crypto, et cetera. And so that was the bridge. That was how the virus jumped from crypto land to mainstream banking. And then Silicon Valley Bank fell right after that. So now, we have, we've gone over the kind of capsule history of Silicon Valley Bank and so forth. But now the contagion spreads to Credit Suisse. But let's get in our time machine and go back to 2014. Brisbane, Australia, November 2014. What happened? That was a G20 meeting. And it was not long after the 2008 financial crisis. And the biggest blowback out of 2008 is, hey, the taxpayers bailed out everything, which they did. they didn't get any reward, and all the big shots kept their jobs. Jamie Dimon's bonus didn't get whacked. I mean, they all kept their jobs. John Mack and Jamie Dimon, and you go down the list of names. Lehman Brothers failed. Okay, they were carried out feet first, but all the other banks were propped up by the Fed. I mean, Morgan Stanley was days away from failing. You go back over the history of that. They were calling John Mack saying, "Could you bail out Lehman?" He was like, "I'm kind of busy bailing myself out right now." And Morgan Stanley would have fallen, Goldman next, probably Citi, if JP Morgan was the last guy standing, don't know. But that's what was happening. As I said, they dropped the curtain, truncated it. They made Goldman Sachs and Morgan Stanley bank holding companies overnight. I've worked on bank applications. They take 2 years if they like you and 3 years if they don't. But this happened in literally overnight. Hey, you're a bank holding company, which meant the Fed could bail them out, and they did. But there was a big political reaction to that. This contributed to, the rise of Donald Trump, the rise of the Tea Party, Nigel Farage. I mean, there was just a lot of nationalist conservative blowback to this. So the elites at the G20 meeting said, we can't have that happen again. So here's the new deal. We're not doing any more bailouts. We're going to do the bail-in. And what's the difference? The bail-in is we're just going to whack the parties in interest. So equity gets, so in a crisis, in a collapse, there's a hole in the balance sheet. Equity gets wiped out. Depositors are going to get wiped out to the extent needed to fill the hole in the balance sheet. And senior creditors, we're just going to keep going and take money from all the holders of any level until the hole in the balance sheet is filled. And only then will the government get involved, but hopefully that won't be necessary. No more bailouts of bondholders, in other words, no more bailouts of depositors. That was the bail-in rule. So now comes Silicon Valley Bank. What happened? The FDIC actually did the right thing. They said, okay, bail-in applies. We're not going to go to the taxpayers or the insurance fund. We're going to say those deposits are gone. And they did. But that lasted 48 hours. And then they said, just kidding. The deposits are all good. So they abandoned. So this is, nine years, 2014 to 2023. This is 9 years of living under the bail-in regime. And when they tested it, it only lasted 48 hours. Okay, so that was a joke. So now come over to Credit Suisse, and this is your question, Brian. What did they do? Well, if you were applying the Brisbane bail-in rules, you would have said equity zero, bondholders, okay, you're going to take a loss, etc. It's not what they did. When the Swiss National Bank did the shotgun merger, UBS gave $3 billion to equity. Now,